Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go, generally related to wealth building, commodities, and/or financial topics. And let's dive in there, see what people are sharing. You can follow me at finding_finance, and you can join our community at finding-value.com, where I share my opinions on individual sectors, individual companies. You can see what I'm doing in my portfolio and whatnot. So, diving down, we've got John Flynn here. Option one, rent a house for $2,500 a month. Option two, give the bank $100,000 and pretend you own a house for $4,000 a month, knowing $2,700 is going to interest. Well, I think that's the options that maybe perhaps this guy has proposed. And when I look at that, obviously option two would be a better option at this time. I highly doubt that option one is the same as option two in terms of the same exact house. But I'll just make this point. What if, and this is, a big what if, but what if home prices don't go down? What what would your analysis then be? And what if rent prices of single family homes or whatever you're interested in potentially living in, what if they don't go down but they go up dramatically? What if we squeeze the rent price and it continues to squeeze? So, I look at things where I want to lock in my costs and try to lower those costs as much as I can. And that's what I did, some years ago. Is we'll call it five to 10 years ago. So by me doing that, my mortgage, insurance, and property taxes are one third what it costs right now to rent the same exact home or to rent a house in the area that I am in. I'm at one third. So it's not about the potential question of today. It's about what does it look like for the 30 years or 20 years that I'm looking to live in a certain area? And what would my cost be, the lowest cost be for the potential options that I have over that time frame? So it's always going to look like it's going to be more expensive to purchase at the given time when you're doing the analysis. Most of the time, that's the case. Maybe not all the time, but most of the time. But here's another question. And this question isn't about people living. If you had two, three, four, $5 million and the governments are printing money like heck, where do you put that money? Where would you store your wealth, so to speak? And what if interest rates are still low? They're not super high, but what if they do come back a little bit and they go back to 4 or 5%? What do all those people do? You're not going to buy bonds with it. You're not going to do a lot of the things that, if you're a multimillionaire, you're going to go rent a house or you're going to buy something. If you win the lottery, what's the first thing you're going to purchase? Probably a nice house. So obviously, I think homes are probably very high on the list. And if anyone has any sort of money, I just don't see those people renting. They generally buy. And I'm not saying that they all do that. I'm just saying in general. So I don't know. I mean, obviously, looking at this, option two is the better bet in the short term here. But I'm also not sure that home prices are going to go down all that much. And if we get lower interest rates, I think the home prices are going to go up, not down. The FI couple, it says a good 9 to 5 job that pays $100,000 a year with full health benefits employer match plus 3 weeks paid time off. This could be an amazing way to build wealth and gain early financial freedom, especially if they live on $60,000 per year. And one thing that I think a lot of people don't think about is $100,000 for a family. I would say you're basically cutting corners on everything. $100,000 a year with 2 or 3 kids is not enough money in the United States, and with even a low locked in, we'll call it mortgage at like 3% mortgage, things would be really tight because you always want a buffer, some cushion, and then you got to pay taxes and there's other things. So I'm in the camp that $100,000 a year for a family of 4 or 5, it's going to get tight. That's what I'll say. It's going to be tight, especially if the kids are a little bit older and they start eating a lot of food. So what I did is I saved my money when I was younger, knowing that if I were to have kids, that things could tighten up. So I've been investing in my 20s for kids in my 30s and 40s, and that money can earn me dividend income. And that's how I'm increasing my income is through a lot of dividends. The wealth coach here says everyone's hoping for another 2008 housing crash to happen so they can buy. But there's a few problems with this. 2008 crashed was caused by many problems in lending that don't happen today. It was once in a lifetime event, and it was just 16 years ago. There's just too much money on the sidelines waiting to buy from investors, first-time homebuyers, people waiting to move, etc. Don't wait to buy real estate and wait. I think that's a pretty good summation there. And, I think if you can afford to buy something with inventory this low and you can afford it, you could buy it, like he's saying here, and wait. And if we do get a slowdown in the market, like a recession, interest rates would go down. You could refinance, but I don't think home prices are going back down, even during a recession. I think people have that wrong. And the reason they have it wrong is because the demand is too great. And if the affordability comes into that demand, my guess is that we'll get higher home prices. That's just my guess. Doesn't mean I know what's going to happen in the future, but that's my guess. Full transparency here. I currently have about 200,000 in cash. My intuition tells me to invest it into the S&P 500 until I find another worthwhile venture. For those with more knowledge than myself, is this a bad plan? Well, the S&P 500 is more or less a think that we're at the wrong juncture for that to be a good plan. We've had increasing interest rates in the S&P 500. It'll do okay with increasing interest rates. I think it's easier and better in commodities, especially ones that are way undervalued. But if we do get a slowdown in the market, which will lower interest rates, I think it's going to impact the S&P 500 in a negative way. I think it go down. But that's also trying to time the short term. That's market timing. What I would do is I'd just go after the undervalued assets, and I don't think the S&P 500 is necessarily undervalued. So I would wait. That would be me, and I would buy undervalued commodity sectors. Alberta's oil industry set to soar. So Alberta production has been especially strong, hitting a peak of around 4.1 million barrels per day in January. With the eagerly awaited opening of the Trans Mountain Pipeline expansion, Alberta's oil producers are well positioned to ramp up production and revenues. I actually agree with that. A lot of the stocks in Alberta have done very well. In the oil sector. Zero Hedge, Goldman pounding the table on AI energy theme and pitching CCJ as a top commodity idea for the space, Camco. So you can see here power, who can supply competitive power and commodities for data centers. NextEra Energy, NRG, there's CCJ there. EQT is what they've got. Who adds incremental capacity to meet generation, so battery storage, solar development, regulated utilities, who provides infrastructure for it. And then they've got the infrastructure there. Laser blue, copper has a structural issue. What is that? Which is that the average project is now 30% smaller than it was in the last decade. So now you need a lot more projects. It's 40% at least more cost wise to do, and it takes at least 50% longer to do. So a lot smaller projects, they cost more and they take longer to get online. And there's some wicked supply deficits that are projected in the future. And I think I've got some of those, but below here. So here's B of A. Hiring has reaccelerated in 2024. That looks pretty good. You can see we've been coming on up here over the past few months. So it says hiring has reaccelerated in 2024. Will it continue in April? Question mark. So we've got hiring going up, which is usually not a hallmark of recession or slowdown. Nostra says U.S. treasuries are going to crash and yields are going to double digits. The BOJ will eventually have to sell their stockpile of treasuries to save the yen. They will have no choice. You know, we could see yields continue to go up. I don't know if they'll go to double digits, but it sure looks like they'll continue higher. That's what the charts suggest. Been seeing a lot of posts whining about home prices, rates, etc. It's not fair. It's harder today, yada, yada, yada. Let me get you in on a little secret. You can't control prices or the rates or the economy. You can control your actions. Spend less, earn more, invest the extra. Today, it's prices. Tomorrow, it's the economy. Then it'll be markets. It's always something. You just got to figure it out. The choice is yours. And yeah, I did everything in my control to lock in a low mortgage rate, to lock in a low house price. And I pulled the trigger when I found out about the real estate cycle. And that's something that we talk about on the website is the real estate cycle. So here's gold silver. He says $8,500 gold in 9 months. That would just be a copy of 1979, 1980, when gold went from 200 to 850 per ounce. Will that come? I don't know, guys. But and I don't think this is a projection by him. He's just saying if this were to repeat like 79 to 80, that is where the projection would be in 9 months. If this price move repeated, which is crazy if you think about it. Giovanni says, oil sands operators up in Canada enjoying firm profits on strong production are getting ready for a major boost when a new export pipeline to the Pacific coast goes into commercial service this week, and that's that Trans Mountain pipeline. So oil sands up in Canada, Alberta is a good spot to be looking. Gold silver, I think there'll be more frightened capital that'll move out of conventional investments into the metals than ever before, says David Morgan. That is when a commodity bull market gets moving and a precious metals bull market. It's people getting frightened out of their current holdings. So when technology stocks start to go down, that's when you might see the money rotation. And that's where I think he's referring to. His money's going to be frightened into something like that. And usually that takes the selling or the pain being inflicted on the current assets that they currently hold for them to rotate that money around. Robert Friedland says copper supply will plunge if miners don't get spending. So this is copper production from existing mines, committed projects, and primary demand. You can see this gap starting to open up from 2024 onward. And the gap really starts to grow at about 2026. So this is what we're facing here in the short term and in the longer term. Trans Mountain Pipeline set to flow May 1st. So that is in 2 days. Well, one day if you're listening to this. Silver squeeze. Global silver deficits are expected to increase by 17% and show no signs of rebalancing as supply is declining. So we've got deficits increasing as supply is declining. Here's another one. I do not see this as the high point for the year. I think we're going to get over $30 for silver, says David Morgan. I do agree. I think it's a very high possibility. COPX and silver in USD. So copper miners breaking out, and there's a high correlation between COPX and silver. So here we are moving on up, and COPX and silver most likely going to break out. So another thing to keep in mind that maybe people aren't thinking of, the small silver miners are not the ones who produce the majority of silver in the world. It's the big boy mines that are producing copper, and silver is a byproduct with along with other metals during that production of copper. If we're going to go into copper shortages and we don't have the mines set up for producing a bunch of copper, that probably also means that we don't have the mines in the world set up for silver. Because if silver is a byproduct of mining copper, and that's where the majority of silver comes from, well, we could see depletion rates in those old copper mines potentially, and maybe that impacts silver too. And we can see how correlated this is. Global X miners up here, and then silver rip into the upside as well is the bottom one. Markets in mayhem. Cocoa is crashing down 14.3%, probably nothing. Well, I mean, guys, when you look at this chart here, I'll get it back in. I mean, it's not going to go up forever. So whenever you what you want to do is you want to buy at a base that's like breaking out. So you get like a stage one base back before this. This is stage two, and then you get the ramping blow off top. You don't want to be entering up here, in my opinion. That's where you sell. So yeah, obviously this is going to sell off at some point, and generally what you do is you start getting bigger red candlesticks like this. This is what Nvidia is going through. This is what SMCI and a lot of the tech stocks, they're getting these big selling pressure candlesticks. And then you get a big sell off pressure candlestick like this. This is the beginning of a move lower, in my opinion, for cocoa. And we'll see. We'll see if it goes lower. Here's gold. It says the detailed chart from yesterday's podcast outlining what I consider to be a reasonable target for the end of this decade. A big move on up, potential break. Maybe we get a pullback here. It says, but this would be a similar magnitude, 20-25% pullback. Multiple techniques show targets in this range, and maybe we move on up in the later 2020s. He says $8,000 to $12,000 target subject to constant review according to incoming data. This is the 5-year roadmap that he's got. We've got positive rate of change breakout here. It says be ready as we work our way on up. He says the roadmap only changes if we close a month convincingly above the $2,700 area, or we close a month convincingly below the red support line. Another possibility is a move past the 2,700 area, maybe beyond 3,000, then a drop to a back test, the 44-year resistance line. That would be incredibly bullish as long as price remains above the 3-year moving average and 24-year support line. Bullish outcomes are more probable than bearish ones. The so-called 8-year cycle is actually a 7 to 8.5-year cycle, is what he talks about. And he's also got some projections here, Fibonacci extensions from here and then to the back down here, which could occur from 4,500 all the way to something that is as much or more than 8,000, but that would be the next leg up. So yeah, looks good for gold. We've got nat gas power burn. That's up about 5% year to date. You can see the green line here above the other 2 years before it, 22 and 23. So an increase of 5% for nat gas power burn. Corey says the dividends are the purest form of passive income. So open a brokerage account, find a brokerage that doesn't charge fees or commissions. So that's good. That's step number one. Step number two, link your bank account and deposit funds. So you get your funds in the brokerage account. Do your research. You can earn dividends from single company stocks or through funds. Single stocks increase your risk, but also have the ability to. She's showing the Schwab US Dividend Equity ETF, SCHD. And then purchase dividend earning stocks and or funds. Starting is the most important action. You never start, you will never gain. Buy a share today and consistently buy each month is what she is suggesting. And then they talk about snowball analytics is the best tool I found to track my stock investments. So that is what we do on the website. I do have a lot of potential investments with big dividends. Those dividends range as low as zero, obviously, but they go as high as mid 20 something percent at this time. There were a couple investments earlier that were over 30-40% dividend yields. Now, I don't buy a stock just because it has a high dividend yield. I want the market condition to be prime for that company to continue to pay at least the dividend yield that it has, and also the potential to pay more dividends in the future because what they sell is going up in price. So I want to buy undervalued assets and companies that sell undervalued commodities in an environment where they'll go up in price. So your dividend yields could continue to increase as the price of the commodity goes up. Sometimes I'm buying commodity stocks that used to pay dividends. They cut their dividends because they're so low, and I buy them when nobody owns it, and their dividend was cut to zero. And then I wait for the commodity price to come back up to the upside, and their dividends generally come back. And if you can ride an entire cycle, you'll get huge dividends alongside stock price appreciation. It is a great way to be able to hold companies is through the lulls or the consolidations, they continue to pay you dividends, which is, it's really awesome, is what I'll say. So here's PAAS. This is Pan American Silver. Pan American Silver is maintaining the upper end of its range, where we might be seeing the start of a bullish continuation pattern building after rebounding from support, indicating sustained buyer interest. So let's look at the chart here. We've got basically a 1, 2, 3, 4, 5, and then we could potentially go up. So this is that kind of that broadening wedge pattern. You can also say this is an accumulation cylinder, perhaps, where we could be moving on up at some point soon. Or Pan American Silver. Christoph says the index jumps 20% from January low, heads for bull markets. This does look like a bottom, guys. For the Hang Seng index, heads for bull market. We have a higher high and we have higher low from the downtrend break. So this does for sure look like a bottom. Shanghai silver versus COMEX silver, $30 versus 27.29, and the metal continues to go from the west to the east. This is the original post. It was 1 month ago. This is now still dead on, and this is uranium URA equities divided by uranium futures pricing, and this is it's an accumulation bottom that we're looking at. It's called a Wyckoff accumulation area, and it's following that accumulation. The ratio is for this, so we'll see. Don't be sleeping on uranium here. I think we could potentially take off at some point. And here's DNN. This is Denison Mines, DNN weekly. You can see that we are also kind of squeezing up here and have a potential breakout. So we've got a couple of information here. We need to look at this which is that Wyckoff accumulation, and then pair it with some of the technical analysis that we're seeing here in some of the uranium companies. We're just up against resistance. We just consolidated for since 2021, this one big consolidation that we haven't broken out of. There's other sectors that are also consolidating. It's not just uranium. Oil is doing the same thing, and energy service, basically all of them. And we're also seeing some of them break out, like copper and stuff. Why would an older house that gets worse over time cost more than when it was new? Well, I don't think the house is the major thing to really worry about here. All of the new homes are not built where I live. All of the homes where I live are older homes, like they were built in the 1990s or early 2000s. So you can't buy in this location where you get a new house. So I think, and in my opinion, location is very important to me. I want a good school. I want to be close to grocery stores, close to banks, close to Walmarts and all that stuff. I want to be close to everything so I don't have to travel a long distance. A lot of the places where new homes are being built, all of that infrastructure around it hasn't really been built yet. So you're kind of out in the middle of farmland, in the middle of nowhere, and you're not next to anything to make life more convenient. So that is one thing to consider when you're buying. It's not necessarily, oh, I'm in a great new house, but what if every single trip that you have to make from that house is 15 or 30 minutes in one direction? Or if you're going somewhere, like let's say you're going and you want to go to an airport and you have to drive, way out there to get to your new house. Or what if the new homes are all being built underneath where the airport is operating, where you're going to get planes flying overhead nonstop. So that's things to consider as well. Here's China thoughts. The street said uninvestable, yes, twice 20% ago. It says stocks are acting like this into a much talked up FX currency devaluation. Uninvestable here, but this is breaking to the upside for the Hang Seng Index. That does look like a bottom, guys. And we can look at potential investment opportunities if you guys want to for this, if you want. And really what this is, and we're already playing it with some of our emerging market stuff, it deals with foreign exchange currency and the rates in a dropping dollar. That's really what it is. Jesse says gold price in the Japanese yen has surged by 165% in the past 5 years as the currency sinks. Yeah, the Japanese yen has a problem here, but look at that move in gold, just ripping it. And that's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We still have the LEAP coupon code active right now. And that will change to May Day, MAYDAY, here when May hits. So that's what I've got for today, guys. We'll catch you later. This is Finding Value.